Hello friends, good morning to all of you, and today this is the class related to the accounting and financial management for the bankers over there, and we are going to start with the unit from module D, that is related to GST, that is goods and services tax over there. So please do confirm the audio video quality at the earliest so that we can proceed. And further, if you want to get the full course of JAIIB, where you'll be getting the access to the full course videos, chapter wise questions, mock test, mega mock test, and the complimentary access to the ePDF notes, this is the right time. Join right now and start preparing for JAIIB 2023, where you'll be getting access for all these for sure success into the JAIIB. And moreover, you can download our Android application that is available in the name of IIBF Learning Center. And if you're iOS user, do download my institute application and use the organization code that is listed over here, that is GEGKT. If I have any queries and any issues related to it, you can get back to us, reach us at WhatsApp number that is listed on the top right bottom over there, top right corner over there. That's the 83609444207. I feel so audio video quality over here seems to be working quite fine. So let's start with the session now. वीडियो को फटाफट से शेयर कर देना एंड चैनल को सब्सक्राइब करना बिल्कुल भी ना भूलना, ताकि जब भी हम कोई नई वीडियो अपलोड करें उसका नोटिफिकेशन आपको सबसे पहले मिल पाए. Do subscribe the channel at the earliest and press the bell notification icon so that you get updated whenever we upload the new video over here. Okay, so let's begin AFM journey with the goods and services tax over there. You're aware of GST, that actually what is GST? Let's suppose person A over here wants to buy a product. Let's say it is worth rupees 100. That's the cost of the product over here. And let's say that the GST slab 18% is applicable over here. Now what amount will be payable by person A over here? Now if the 100 rupees is MRP, in that particular case the GST is inclusive in that particular price. But if it is not MRP, it is a CP, that is a cost price of the product, then GST will be imposed over and above this cost over here. That is 100 plus 18% of the same, that is 118 over here. Now there are two type of taxes which are available over there. One, it is related to the direct taxes, and the other one, it is related to the indirect taxes over there. Okay, and why the taxes are being levied on the individuals? Because the government wants to earn the money for because they want to get the money so that they can invest into the public interest over there. So they do collect the taxes from the individuals, from the business entities and the other organizations of the country over there. And there is actually what? There is a federal structure. Now what do you mean of federal structure? Federal structure means there is a concept of state and center over there. Okay, now when the concept of center and state is over there, the taxes which are being levied are being distributed among the states and the center over there in the aspects of the taxation over there. Okay, so I told you that there are two type of taxations are there, like one, it is the direct tax, and the other one, it is the indirect tax. Okay, let's take the case that you have been earning rupees 1 lakh. You have been earning rupees 1 lakh, and you are to pay a tax on your profit. So whatsoever the profit you have earned, let's suppose you have to pay 10% of the tax. Now this type of tax would be what type of tax? Kindly please do let me know in the comment section below. Now you are a direct user and you have earned rupees 1 lakh profit over there, and let's say the 10% tax is payable over there. In this particular case, this is the direct tax or indirect tax. Definitely this is the case of the direct tax, because it is directly imposed on the user over here. It is directly imposed on the user over here. You are to pay the tax directly to the government over here. So this is the case of the direct tax. Okay, and on the other hand, let's suppose the case of person A again. Person A bought good or services worth rupees 100, and further it was actually the amount of the tax. Let's say person A is whom? Person A is the buyer over here. Person A is the buyer of the goods over here. Now he is to pay a tax. He is to pay a tax, but not directly, because he is paying the tax for the goods, and that tax will go to whom? That tax will go to the seller over here, who is selling the goods over here, and seller will then be depositing the tax to the government authority over there. So this type of taxation is what? This is the indirect tax over there. So there are two type of taxes which are there. Direct tax is directly imposed on the taxpayer, and it is to be paid directly to the government over here by the deducting, and further it includes those taxes which cannot be transferred or shifted to another person, because if you have earned the money, it cannot be shifted to some other person over here. Like income tax is being levied, so that is particularly what, that is the direct tax over here. And when we talk about the indirect taxes, in that particular case, that can be shifted from one person to another. Like you have bought the goods, but you will be paying the taxes to the seller over there, seller will be paying the taxes to the government over there. So that's the case with the indirect taxes. Like previously there were a lot of taxes which were there, indirect taxes, but now those all the taxes which were cascading over there now have been actually collaborated with all, and there is a single tax, one nation one tax policy is there that you are to pay in the form of GST over there. Previously there was state tax, sales tax, some tax, or any other tax, central duty tax or something like that, but now those all taxes are abolished. Only on some limited number of you can say commodities those taxes are applicable, okay, otherwise those are not applicable on all and each services and goods over there, right? So now let's begin with the differences between the direct tax and indirect tax so that you can understand it in a better manner. Okay, now it's related to direct tax. Now direct tax is imposed on what? It is imposed on the income, it is imposed on the profits over there. And if we talk about the indirect taxes, this is actually levied on the goods and services. So whatsoever the goods and services are being rendered and further being sold, the taxes are levied upon that, okay. And in case of direct taxes, it is actually directly paid to the government. When you are earning the income, you're directly paying the tax to the government now. So that's particularly the direct tax, okay. So when we talk about the income tax, it's a direct tax over there, and when we talk about the GST, it's actually the indirect tax over there, okay. You can understand it in a better manner. And further, in case of indirect taxes, generally paid through intermediary. It's not like that you will be paying it directly, it will be paid through intermediary. Like seller sold the goods to the buyer, buyer is paying the tax, but buyer will not be directly paying the tax to the government. Buyer will be paying the tax to the seller over there, and seller will then be paying the tax to the government over there, okay. So that's the concept related to the GST over there. And further, in case of direct tax, the burden of tax cannot be shifted. Like if you are earning the income, you have to pay the tax. It will not be the case that the other person will be paying the tax. But in case of GST, you're not if you are actually earning the income, like if I am selling a good, I am earning the income, I will not be having the liability to pay the tax, because I am shifting the burden of the tax to some other party, that's a buyer over there. Buyer will be paying the tax, and further I'll be depositing the tax to the government authority over there, okay. So that's the case related with it. And further, probability of tax evasion is higher in case of direct taxes, but the probability for evasion, because it is much more transparent, okay. So probability of evasion of tax is lower in case of the indirect taxes over there. And further, it helps in reducing inflation. How does it helps in reducing inflation? Because overall, if we look at it, it will be related to, it is not adding any other cost to the product cost or the services cost over there. On the other hand, if we look at the indirect taxes, now previously if the service was available for rupees 100, but now 18% GST is imposed. Now that particular service is now available, same service is available for 118, and that is actually the concept of GST, where you are to pay some extra amount for the same. So it enhances the inflation over there in case of the indirect taxes over there, okay. And then it's related to, it is progressive. The direct tax is progressive, okay, whereas the indirect tax is what? Indirect tax is regressive. Regressive means कि वो पीछे को लेके जाएगा, it will actually bring you back, and further the direct taxes will take you forward, okay. It will be a forward step, because it's like that it will be helping the government so as to establish new things. Whereas the case of the indirect taxes, it's a extra burden that is imposed on the buyers over there, okay. And further, it helps in reducing the inequalities, where the indirect taxes enhances the inequalities, because only the person who is having the more money in the hand or more money in the pocket will be able to buy and something use the services over there, okay. And further, collected only from respected tax brackets over there. Now the new slabs are available. Now as per the slabs only, you have to pay the tax. If you are earning rupees 1 lakh, you are not to pay the tax, because it is exempted up to some certain limit over there as per the IT Act over there, okay. And in case of the indirect taxes, it is collected universally. It's not like that even if I am earning rupees 1 lakh, or I'm earning rupees 1 crore per year, I have to pay the GST on the products. Okay, so that's collected universally. And further, in case of the IT, in the case not IT, in case of the direct taxes over there, it actually reduces the saving. Previously, if my profits were rupees 5 lakh, or let's say my profits were rupees 6 lakh, and I paid rupees 20,000 as the income tax, then definitely my savings are reduced, my investments are discouraged over there. But in case of the indirect taxes, now it is growth oriented. It is growth oriented. It actually discourages the consumption. Now the consumption is discouraged because the cost value for the buyer is now increased. Previously the service which was available for rupees 100, now it is available for rupees 118. So in a way it actually discourages the consumption because the overall cost is now increased and the lesser person will be buying it. Okay, so it actually enhances the savings over there. And the direct tax is fixed as per the slabs. So whatsoever the tax slabs would be there, the tax is to be paid in that particular manner. And further, in case of the indirect taxes, it's an additional tax. It's an additional tax on the so whatsoever the additional tax that is to be paid. So that's the concept related to direct taxes and the indirect taxes over here. I hope that you must have understood the differences between the two, because it is quite important just to learn about it. Kindly please do like the video at the earliest, and do give this video a thumbs up if I have really been liking the video. And if you feel any issues, and if you're having any suggestions related to the same, kindly please do let me know in the comment section so that we can improve ourselves. Okay, so now let's move toward the goods and services tax over here. Now GST was introduced from July 1 and 2017 over there. Now central and state whatsoever the different taxes were over there, those were amalgamated into the single tax, and further it is quite much more transparent and easy to handle. Like previously, let's say if 12 different taxes were there, and which were levied on different products and services, now those all brackets, those all segments were to be maintained. But now there is only single, all those taxes have been basically amalgamated. It's just a random number. Okay, so all those taxes have been amalgamated. Now there is a single tax which is available over there. Now it is quite easier to handle that particular tax, and it is quite more transparent because single tax is actually quite easier to administer, and moreover it has reduced the physical interface and lower the cost of compliance as well. Okay, now previously if I was to pay multiple taxes, I have to comply in multiple manners over there, but now that's not the case. And GST is levied on all the transactions like sale, transfer, purchase, barter, lease. We actually read in the case of the lease financing chapter over there that GST is levied on lease also. Even if you are importing goods or services, the GST will be there. And moreover, it's a comprehensive tax. Like it is full on full. It is actually complete in itself. Okay, so almost all the indirect taxes except a few state taxes, it is actually a comprehensive tax over there, that on each and every product and services the GST would be levied. Okay, but in the case of the crude oil, petroleum products, electricity, alcoholic liquor for human consumptions are not covered under the GST regime over there. So that is to be kept in mind. Okay, so that's related to it. Now let's understand the components of the GST over there. So there are 4 types of GST in India. For now, it is a SGST. SGST over, it is a state GST over there, and CGST is central GST over there. IGST is integrated GST over there. UTGST is union territory GST over there, or simply we can say it UGST over there. Okay, now what actually these 4 types of GST and why it is being there, let's understand this. Okay, now let me quote an example to you. Let's take the case first of all, if the transactions made within a single state, like if I am residing over here in Punjab, and that is, let's say I am the seller, and further the buyer is also from the Punjab, person A is also from the Punjab over here. Okay, and I have sold the goods to the person over here, or I have rendered the services to the person A over here. In that particular case, there will be the 2 components. Let's take the case on the transaction is worth rupees 100, and on this particular transaction, the GST slab is 18%. There are different GST slabs, like it is 9%, 12%, 18%, 28%. So different GST slabs are there. Okay, so now let's take the case, it's 18% GST which is levied on this particular transaction over there. Now the amount of the GST will be rupees 18. It will be rupees 18. Okay, but the part would be that it will be divided into 2 components. One, it will be the SGST component. One, it will be the, if you have looked into the invoice or something, you must have found that there are two components when you are buying from the same state. That one, it is the SGST, and the other one, it is the CGST. Other one, it is a CGST. Okay, now SGST would be 9% and CGST would be 9%. Now 9% component will be remained by the state government, and for the other 9% component will be passed on to the central government. Okay, so that's the case related with it. Okay, but when there is an interstate transaction, let's take the case. Let's take the case that a person over here is not residing over here in Punjab, but he is residing in some other state than Punjab. Okay, in that particular case, what component will be there? It will be the IGST. It is the IGST, that is the integrated goods and services tax over there, IGST. Now in this particular case, IGST, the complete component will be 18% if I'm considering the same transaction where 18% GST is being levied. Okay, so now in that particular case, 18% GST is being levied. The component would be shown under IGST head only if it is interstate. If it is interstate, that is buyer is in some other state and the seller is in some other state. Okay, they are not from the same state itself. Okay, now in that particular case, 18% component is IGST. Now this 18% will be actually transferred to the central government, and central government then will be transferring the benefit of 9% back to the state government. Okay, so that is the case over there. That is the case over there, that the state government is not passed on with the benefit of 9% directly, but first of all it is paid to the central government, then central government pays the amount back to the state government over there. So that is actually the case of the interstate transaction, or when we are importing the goods or services over there. Okay, and the other one, last one, it is related to UTGST, because when the states are involved over there, it's a component related to what? It's a component related to CGST, it's a component related to SGST. But when the component when the state is not over there, let's take the case it's related to Chandigarh. Now Chandigarh is not a state, it's a union territory. Same way Andaman Nicobar Islands, that's not a state, that's a union territory over there. In that particular case, what component will be there? It will be the UGST. Like we understood the case of the SGST, na? Like let's say that a person is buying and selling the goods in the union territory of Chandigarh. Okay, in that particular case, what components will be there? It will be the CGST and UGST. Okay, so that's related to it. Now it's a very important point to understand that GST is actually what? GST is a destination based tax. GST is what? GST is destination based tax. What did it indicate? It indicate actually it's related to consumption of goods and services. Okay, now let's take the case that the person A, who is the buyer, is from Gujarat. It's from Gujarat over here, and the seller is from Punjab. The seller over here is from Punjab and the buyer is from the Gujarat. Okay, so if I'm from Gujarat, give this video a like over here. If you're from Punjab, give this video a like. Others can also like, it's free. Okay, now let's focus on this particular subject. Okay, so the buyer is from the Gujarat and the seller is from the Punjab. Now where the goods and services are being consumed, where the goods and services are being consumed, taxes will be paid to that particular state only. Like if the seller is from Punjab, and for the component which will be shown in the invoice, that will be the IGST, because it's a interstate transaction. It's a interstate transaction. The component will be IGST. Let's take the case 18% GST was applicable. Now in that particular case, the amount will be paid to the central government. Okay, now central government will be transferring the benefits of the taxes to the state over there. Not to what state? To Punjab or Gujarat. It will be actually be transferred to the Gujarat over here, because GST is what? GST is destination based tax, and actually it is based upon the consumption of goods and services. It's not related to that which state has sold, but it's related to which state has consumed. Okay, so that's related to it. Now let's understand the concept related to the GST Console. So GST Console is a governing body. Now the GST was applicable down. Definitely we need a body which actually will be maintaining or will be the decision making body related to it, and Union Finance Minister is its chairman over there, and it also includes a Minister of State and further the state finance ministers over there, and it makes recommendations like which goods and services may be taxed, what will be the tax slab, and from where we can do have an exemption, GST rates, etc. All these things are being finalized and the decisions are taken by the GST Console itself. Okay, now it's related to very important thing that's related to input tax credit. Now what actually the input tax credit? Let's understand this with an example over here. Okay, now let's take the case that the person A over here is buying the raw material, and further after raw material the goods are being processed and further being sold. Okay, now he purchased raw material worth rupees 100 and further processed the goods and further sold the goods for rupees 200. Now that is a case related to it. Okay, now previously on the raw materials, also those are the goods and services, no, because he has bought the raw material as goods only. Okay, so he paid GST of 18%. Let's take the case he paid 18% GST on the raw materials. So he has already paid rupees 18 as GST. He has already paid rupees 18 as GST over here. Okay, and further when he sold the goods, also he collected the GST. He collected the GST from the buyers, because I told you that the buyers will be paying the GST. The GST will be paid to the seller over here, and seller will then be depositing the GST to the government authority over there. So that's the case related to it. Okay, so buyer now have paid the GST on price of rupees 200. Let's take the case they paid 18% GST again. 18% of 200 rupees, it will be 36 rupees. Now rupees 36 GST have been collected by A from the from the buyers over here. Okay, now the input of rupees 18 is available. Input of rupees 18 against, because he has already paid rupees 18 as GST. Okay, now that is available because GST is not availed on GST itself. Okay, so it's a case that rupees 18 GST is available over there because set off for the tax paid for the inputs. Now the inputs are related to what? Input is related to raw materials which he has purchased already, and further he has already paid rupees 18 as GST on that particular input over there. Now that is to be set off. That is to be set off against the GST which he has collected. Now GST collected rupees 36 and he has already paid rupees 18 over there. The net GST he is to pay right now is rupees 18. Okay, now how we calculated the input tax credit? The input tax credit is related to the tax, the GST tax he has already paid. Okay, while basically having the raw materials, he has already paid that particular GST, so he can take it as an input. So this will be the input amount of the GST which will be available, which will be setting off the net GST to be paid. Okay, so the GST was to be paid to be rupees 36 because he has collected the GST from the sellers over there, and as per the rule he is to deposit the same to the government authorities, but the input was available for rupees 18 over there, so net amount which will be payable, it will be rupees 18 over here. So that's a concept related to the input tax credit. I hope that you must have understood the same. Okay, that's related to the input tax credit. Now who will be liable to pay the GST? Now who will be liable? Definitely the seller of the goods. The seller of the goods, the supplier. The supplier, simply I told you right now, by now we have understood that the supplier of the goods is to pay the GST. He is the liability, he's having the liability, because buyer will be paying, the buyer of the services will be paying the GST to the supplier over here. Supplier over here is to pay the GST to the government authorities over here. So that's the scenario, but definitely there are some exceptions, like when we are importing the goods, from let's say we have imported the goods from USA or from some other country, and let's say there are some other notified supplies which are the cases where the buyer is to pay the GST. Okay, in that particular case the buyer is to deposit the GST, but in a general sense, who will be liable to pay the GST? Supplier will be liable to pay the GST over there. Okay, and further, and also some notified cases of intrastate supply of services, like when there is intrastate supply of services, in case of notified services only, where it has already been notified by the GST Council that the buyer will be depositing the GST over there. The liability to pay the GST, like in case of the e-commerce operators are whom? Let's take the case over here, we are having the PayU Money. We are talking about the PayU Money. Okay, now PayU Money is what? It is a e-commerce provider, e-commerce solution provider over here. Now PayU is based upon Noida, and we are here situated in Punjab. We are here in Punjab over here, and further, whatsoever the services, whatsoever the amounts being received, it is being received through PayU Money. Okay, the persons are from different states. Let's take the case, even if the person is from Punjab, he will be paying through the PayU Money gateway that is in Noida. Okay, that is in Noida. In that particular case, not that particular case, who is a buyer over here? Who is the buyer over here? Buyer is a person who is from Punjab or from other state. But who is the seller actually? Who is the seller over here? Seller is also from Punjab. The seller is also from the Punjab, but the person who is intermediate is actually from the Noida, who is receiving the money on behalf of seller over here. Now in that particular case also, the e-commerce operators are basically casted that they are to pay the GST over here. So that's the case where the liability of the GST will be on the buyer itself. Okay, so he's also service provider over here, and further he's also service provider, but is a consumer for the seller over here. Okay, so that's for the case. These are the exceptions. These are the exception case where the consumer is to pay the GST over here, and the government departments making payments to vendors above specified limits are required to deduct the taxes over there. Like in the TDS is applicable. We have already learned about the TDS and TCS over here. In that particular case also, the TDS is to be deducted. The TCS is actually to be collected by the e-commerce operator over there, and that is to be deposited with the government departments over there. Okay, now let's understand the threshold limits. Now it's 20 lakh rupees is the threshold limit for the GST over here, and it is rupees 10 lakh for the northeastern states or Uttarakhand and Sikkim and Himachal Pradesh over there. Suppliers below the threshold limit are not required to register or pay tax. What did it indicate? Let's take the case. I'm a shopkeeper, and my annual sales are 12 lakh rupees. It is rupees 12 lakh. Okay, now in that particular case, I'll be having no liability so as to pay the taxes. I'll be having no liability so as to pay the GST over here, and also I will not be getting any of the input credits. Too. So that's the case of what? That's the case of the threshold. Okay, so if you are not basically covering the threshold, in that particular case there will be no liability over there, and it is rupees 20 lakh in general. But in case of the northeastern states over there, Uttarakhand, Sikkim and Himachal Pradesh, it is rupees 10 lakh. Okay, then it's related to liability to pay the GST over here. Now the liability to pay the GST is there, and it actually arises at the time of supply of the goods, and further in case of goods it is covered under section 12, and in case of services it is covered under section 13 of the GST Act over there. Now in what event the GST liability will arise? Now what event will be there? When it will be the case that we are to pay the GST, like it could be related to that there is a agreement between the buyer and the seller, then they are to pay the GST, or it could be the case that the buyer has paid the amount to seller, then they are to pay the GST, or seller has concluded the transaction and has transferred the ownership of the goods, then they are to pay the GST over there. So it's the case, the time is the earliest of one of the three events. Now what are those three events? First of all, if the payment has been received by the seller, received by the seller, that is the first event. On issuance of invoice, if the invoice has been issued, the liability to GST to pay the GST arises. And the third one is related to when the supply is completed. So if these three events are there, then earliest of any of these three events, the liability to pay GST arises. Okay, so the GST liability arises at the time of supply over there, and further in case of goods it is actually explained in section 12, and in case of services it is explained under section 13 of the GST Act. I hope that you must have understood the same concept. Okay, now who is to file the GST return? Now like we are to file the ITR. Now if we are to file the ITR, now let's say person A over here is having an annual income of rupees 9 lakh. He's having an annual income of rupees 9 lakh. The GST, not GST, the income tax will be actually levied. The income tax will be levied. Now what type of tax is income tax? It's a direct tax. We have already learnt about the same. Now the person will be actually depositing the tax directly to the government. Whatsoever the tax will be applicable, the taxes are to be paid by person A directly to the government over there, and further that's a direct tax, and he'll be filing what? He'll be filing ITR, that is income tax return over here. Now, in case of GST, the GST is being paid by the buyer to the seller over there. Seller will be depositing the same to the government authority itself. The seller is to file the supplier is to file the GST returns over there. Now, every person who is a registered GST person over there, every person who is registered under GST will have to file the returns in some form or others. Okay, so if you have registered for GST, you are to file the GST returns. And let me take you to the chart over here. Okay, you have to pay the GST over here. You are to pay the GST. That's the thing that is to be done over there. Now, if you have been, if it's related to the monthly, either it could be related to monthly returns are there and further quarterly returns are there. Now, let's take the case. Now, let's take the case that who is to file the GST returns. Now, a person who is actually registered with GST is to file the return in one way or other. They are to file the returns over there. Okay. Now, in case of normal supplier, you are to file the monthly returns. Okay. And further, if it is a composition scheme, if you are under the composition scheme, now there was a composition scheme which was actually launched there by the GST over there. In that particular case, you have to file the quarterly returns. Otherwise, in case of normal supplier, you have to file the monthly returns over there. Okay. And an input service distributor will have to file the monthly returns showing the details of the credit distributed during the particular month. Now, if your input service distributor, like you are rendering the services over there and further receiving the amounts over there, now in that particular case, you are what? You are input service distributor. Over there. Now, in that particular case, you are also to file the monthly returns so as to indicate that what persons the credit is distributed. Okay. And person who is deducting the TDS or who is collecting the TCS, like we have already discussed in case of the e-commerce companies, they are also to file the monthly returns over there showing the amount so deducted and collected and for specific details over there. And also in case of non-resident taxable person, now person who is non-resident but a taxable person, also they also do file the returns for period of activity undertaken, like if they have been rendering the services, if they have been selling the goods over there. Now, even if they are non-residents, they are to actually comply with the rules over there and further to file the GST returns over there. Okay, now we have understood one important part. One, it is related to that every person who is registered under GST is to file the returns over there. Now, in case of normal supplier, monthly returns are there. In case of composite scheme, if I have availed the composite scheme, you have to file the quarterly returns over there. And if you are even collecting the TCS or you have been deducting the TDS, you are to file the returns over there. Even if the person is non-resident taxable person, the person is to file the returns over there. So that's the case related to it. Now, the banks are service providers. Composite scheme is not applicable to the bank over there, and they are to file the regular returns over there. Okay, so that's the case with it. And then it's related to returns to be filed. What type of returns to be filed and what is the periodicity, and further up to what amount what return would be applicable. Now, I have actually created a table related to the same. Now, if the aggregate turnover of the GST person, if the aggregate turnover of the registered GST person is greater than 1.5 crore, if the aggregate turnover is greater than 1.5 crore, the person is to file the GSTR1 also. And further, the periodicity for GSTR1 is quarterly. And further, if the person is having an aggregate return up to rupees 1.5 crore, in that particular case, GSTR3B is to be filed, and that's a monthly return. Is that clear? Okay, so return for registered person with aggregate turnover of more than 1.5 crore, in which case the manual details are to be entered. In that case, GSTR1 would be applicable, and further GSTR3B monthly return where the aggregate turnover is up to 1.5 crores over there. Is that clear? So that's the point related to it. You need to memorize the same. And also, if you're not actually filing the returns, if you're not paying the GST amount, so let's say that your liability was 1 lakh rupees. The GST paying liability for you was 1 lakh rupees. Let's say the case that you are a supplier, over here, and there was a liability on you that you have to pay a GST of 1 lakh rupees to the government. Okay, but you have not paid the same. You have not paid the same. In that case, interest will be levied above this particular amount. Okay, and the interest applicable would be 18% per annum. Now let's take the case that the liability was there, that you are to pay the GST by 24th of the month, by the 24th of the month, but you have not paid the amount by 24th of the month. And let's say the case, in that particular case, the due date will actually be commencing from the very next day. The due date is 24th. So the due date is 24th. So from the next day of the due date, let's say from the 25th to the date that you have not paid the GST amount to the government over here, the interest amount, the interest liability will be charged, the interest penalty will be charged, the late fee will be charged in that particular form, and you are to basically pay that particular interest also along with the actual amount of the GST you are to pay. Okay, is that clear? Now let's have a look at the advantages of the GST. Let's look at the advantages of the GST. Now what are the advantages? First of all, I told you that there were multiple taxes. There was cascading of taxes, state taxes, central taxes, different taxes were there. Now those old taxes have been amalgamated, so there was multiplicity of the taxes, and tax rate is now actually reduced considerably. Okay, so complexity is quite simpler now. Now complexity is reduced, and further the tax rates are also reduced over there. Now administration is quite easier. Previously multiple taxes were there, but now it's not the case, so administration is also now easier over there. And GST has made trade and industry more competitive. Now you are not to comply with all the taxes over there, you have to comply with one tax. Now the cost of production, inflation of in the economy is now reduced, because overall cost is reduced. Now previously, let's say if 5 taxes were applicable on one particular good or services over there, so it was quite hectic, because first of all you have to comply with those, you have to basically pay those, so that was quite hectic over there. But now it's not the case, so overall cost is reduced, and further moreover the cost of production and inflation is reducing, and ultimately the economy is now growing over there. Now GST is aimed at broadening the tax base. Now the tax base is broadened because it is applicable universally, and moreover better tax compliance is there. And then it's the case all taxpayers such as registrations, payments, returns, etc. will be available to the taxpayers online. So it is actually IT based infrastructure has made it possible that compliance is quite easier and much more transparent. Now you can pay your GST amount online, and those all things will be available to the taxpayers over there, and it's quite convenient over there. Okay, then GST will ensure that indirect taxes and structures are uniform. Now those structures are uniform. It's not like that the tax slabs are different for different states. It could be different, but in general, if we look at the tax slabs are all same all around the country over there. So that's quite easy to basically understand the tax slabs over there. And elimination of tax, cascading of taxes is there. I have already conveyed the idea to you, and there is no tax on tax. So GST is charged only on the component of the value addition at each stage. Okay, so previously if the stage, let's take the case, the GST was levied on rupees 100. Now the new value addition is rupees 200. Okay, value addition is rupees 200. Let's take the case, in that one case the taxes will be levied on rupees 100, because it is on the value which has been added to the product over. It will not be levied again on rupees 200. Okay, it will be levied only on rupees 100 over here. Over here on rupees 100 the taxes were levied. Now the value of rupees 100 was added up, and now the taxes will be levied on rupees 100 only. Okay, not on rupees 200. So that's the case. So there is no tax on tax in case of GST. GST is charged only on the component of value addition at each stage over there. Is that clear? Okay, now let's move further. It's related to the GST provisions with respect to banks over here. GST provisions with respect to banks over here. Now if we look at the bank, I told you that GST is actually what GST is destination based. Okay, destination based means consumption based over there. Now if the bank is actually having multiple branches in the different territories or different states over there. Now let's say the case that we are considering 3 different states over here. Okay, now this is state 1, ST1, this is ST2, ST3 over here. Okay, now let's take the case that bank is having B1 branch over here, B2 branch over here, and B3 branch in the state 3 over here. Okay, now in this particular case, banks are to obtain a separate registration for each state over there. Okay, they are to take the GST differently for each state, because as the state changes, the GST number also changes over there, because the states will be getting the credits based upon the consumption. Okay, so that's the case. So in that particular case, difference in different states, the same bank has to obtain the different GST numbers over there, and this is quite hectic because the number of GST numbers will be increasing. More returns you have to file each and every time. More taxes are to be paid, and number of return formats will be changed. So level of data and the returns will be increased, and definitely the complexity will increase in that particular manner. Okay, if we look at the third point over there, it's related to input tax credit is leveraged and deleveraged. First of all, we will be talking about the central VAT system. Now previously what happened actually, that whensoever the banks and NBFC they actually opted for the reversal of 50% of the central VAT. Okay, central VAT. Now whatsoever the VAT actually they have paid for the goods and services, whatsoever the VAT they have paid so far, they could have availed the central VAT 50%, central VAT percentage 50%, they could have get the reversal for the same. Okay, likewise we are talking about the input tax credit, they could have asked for the central VAT reversal in the previous case. Okay, also for the capital goods, they could have availed the central VAT. But now under GST, 50% of the central VAT credit, 50% of the central VAT credit is availed against the input and goods and services over there, and against the capital goods there is no reversal. Against the capital goods there is no reversal. Now what are the capital goods? Like let's say that I have purchased, I am basically rendering services, and I purchased some machinery so as to render the services. Okay, now in that particular case, that's a capital good to me. That's a capital good to me because I'm going to use that particular machinery for a longer period. I'm not going to sell that particular machinery over there. I'm going to use that machinery for manufacturing purposes. I'm going to use that machinery for rendering services purposes. Okay, so that's a capital good to me. Okay, now the central VAT percentage is not reversible in case of the GST over there. Now we can say that in this particular case, this is a loss to the service provider, na? So because that cannot be reversed, so that's the case related to it. Okay, so we can say it can increase the additional cost to it. So also let's take the case I told you that in different state, different GST you are to obtain. In different state, different GST you are to obtain, and moreover in each and every state, the adjudicating authority will be different. Like in state 1, adjudicating authority is A, in state 2 it is B, in state 3 it is C. Now each and every person will be having their own POV, they will be having their own point of view on the same agendas. Okay, now the person A will be acting differently, person B will be acting differently, person C will be acting differently. Now this can actually prolong the process of resolution. Okay, so that's actually related to it. Then further it's related to different adjudicating authorities involved under GST, which may be having the different opinions underlying the same for the same underlying issue over there. This contradiction in the opinion prolongs the adjudicating process over there, and that's quite hectic over there. Now, what are different issues related to the revenue recognitions are there? The first of all, it's related to account linked financial services. Now, whensoever there are account linked financial services are being imparted, in that particular case, the place of supply is the location. Place of supply. Now, where we have been rendering the services. Now, let's take the case that we have rendered financial services. And further the place of supply, the person is rendering the services from Punjab, but the place of supply is, let's say, Gujarat or Maharashtra it is. Now the place of supply would be the considered as a main funda, okay, the place of supply is the location of the recipient, that will be considered because it's account linked now. If the account is based upon Gujarat, then it will be actually the place of supply would be the recipient based on the account where the account is being operated from. Okay, so that's the case. And the second one is related to non-account linked financial services. Non-account linked financial services, where the services are being rendered, financial services are being rendered, but that's not account linked. In that case, the place of supply of service here is the location. Okay, in that case, the recipient service was based upon the the place of the supply location. The place of supply is a location of recipient. Okay, but in case of the non-account linked financial services, the place of supply of services is the location over there. Try to understand this particular point. Now it is a if it is a account linked, in that case it is a Gujarat, because the account is being operated from the Gujarat itself. But if it is non-account linked, in that particular case, the place of supply, that is a Punjab, will be considered as a place of supply over there, and it will be considered accordingly over there. Now previously actionable claims were not covered under the services tax over there, but now under the GST these all have been covered, whether it is related to lease, barter, actionable claim, those have been covered. So now whether it is related to the discounting of the bills or it's related to the securitization of the bills over there, those all have been covered under the GST, and further those are now taxed under B2C and B2B. B2C means business to customer, and B2B means business to business transactions. Okay, so those are taxed accordingly over there. Then it's the case of the GST on banking transaction fees. Okay, now previously the fees was not applicable as such, but now there's an extra burden. There is an extra burden, like if you are paying the credit card payments, if there is fund transfer, whether there is ATM transaction. Now each and every service is being rendered. Now the taxes are being levied. Let's take the case that the service charges was ₹20 for ATM transaction. Above the free transaction, it is ₹20. Now the GST will be applied over and above. GST will be applied over and above these particular amount over there. So ₹20 plus 18%, that will be applicable, and that particular amount, the total inclusive amount, is to be paid by the user over there. So that's particularly the case related to it. Now hike in tax rate means individual will have to pay the more charges, they have to pay the more fees for the banking of transactions over there. Now bank branches also do provide the services to each other, like bank branch B1 is providing the services to the same bank branch B2 over there. In that particular case also the GST is right. Still also they can get the input for the same, but it is quite a lengthy process. Now first of all they will be filing the returns, then will be asking for the refund over there, or for the input tax credit over the ITC over there, but it actually increases the paperwork and the operating cost over there, and that is the major issue related to the same. Okay, so that was actually all about the GST unit. I hope that you must have understood the same over here. Now let's start with the another unit that's related to the working capital management. That's a unit from the module C over here, and that's quite important also. So we will be learning the same now. Okay, now it's related to the working capital management. So we will be taking 1 minute break over there, and then we will be starting with the same. Let me just load the file for you, and then we'll be taking 1 minute water break, we can see over here, and then we'll be starting with the same, that is related to the working capital management for the same. Okay, so I'll be coming back very soon. Okay, so next it's related to the working capital management. Okay, now what is working capital? Let's take the case that firm XYZ is over here. Okay, and for day-to-day operations, actually they do require the funds. Like they want to purchase the raw material, they want to pay the rent, they want to pay the electricity bills, they want to pay the salaries over there, and much more about it. Okay, so that's actually related to the working capital that is required, because working capital is the amount that is actually required for the day-to-day operations over there. If we look at the balance sheet over here, we are having the two sides. On the left side we are having the liabilities, and on the right side we are having the assets over here. Okay, so what type of liabilities and assets we are having? We are having the capital and the reserve over here. We are having the long-term liabilities over here. We are having the current liabilities over here. And if we look at the asset side, we are having the fixed asset, we are having the non-current asset, we are having the current assets over here, and we are having the intangible assets over here. Is that clear? Now capital is the amount which is infused by the owner into the business over there, and also it is covering one point that's related to reserve. Let's take the case that the company earned a profit of ₹100 crore in the previous year, And further, they retained what amount? They retained, let's say 30 crore out of this profit, because they know that they require this particular amount for their future purposes. So they retain their amount for some particular purposes. So that's actually what? That's actually a reserve. That's actually a reserve over here, and that's also component of the capital over there. Now long-term liability is actually related to the amount of the loan which has been sanctioned to the firm. Let's take the case that the firm has availed a term loan that is for a longer duration, and also it may be the case that the company may have issued the debentures and the bonds over there. That's also long-term liability. Okay, and further, in case of current liability, it's related to what? The taxes, let's say the rent which is payable, or salaries which are payable, or bills payable over there. Those will be the current liabilities that they are to pay in a shorter span. Okay, so that's related to current liabilities. And now if we look at the asset side, we are having the fixed assets like machinery, plant, etc., plant machinery, etc. That's a fixed asset. Now non-current assets are those assets which are not current assets in nature and not the fixed assets in nature. Like let's take the case that you have invested into the securities, that the company has invested into the securities which are not marketable, which are not, if these securities are not marketable, now that will be the case of what? That will be the case of the non-current assets over there. And if we talk about the current assets, like we are having the cash in hand, we are having the bank balances, we are having the let's take the case, we are having the stock or inventory over here, we are having the account receivables over here. So all those are the current assets over here. And what are the intangible assets? Like patent, goodwill, etc. Okay, that's related to what? That's related to the current as that's related to the intangible assets over there. Okay, now we are concerned about what? We are concerned about the working capital. Now if we look at the gross working capital, what is gross working capital? There is one more concept related to it. One, it's related to, I told you that on the left side we are having the liabilities. The liabilities are actually what? These are the sources, not uses. These are the sources of the funds. Liabilities are the sources of the funds, and the assets are the uses of the funds where the amounts have been spent. Okay, now if we look at the point, if we look at the gross working capital, it is a total current asset. Now whatsoever the total current assets we are having in the firm account itself, those are what? Those are the that is actually what? That is the gross working capital over there. And if we look at the net working capital, the amount of the current assets that is exceeding above the current liabilities, that is the current assets minus the current liabilities, that is what? That is a net working capital. That is the net working capital. And also I can tell you one more thing that's related to now the long-term assets or long-term sources over here. Long-term sources are what? Long-term sources are long-term liability and the capital. Both are the long-term sources. These both are the long-term sources over there. Now long-term sources are there so as to fund the long-term uses. Over there. Okay, now if there is having any extra amount, let's take the case that the fixed assets are worth rupees 100 crore over here, and further the long-term sources are 150 crore over here. Now in this particular case, rupees 50 crore is available extra because that is not being used anywhere. Those are not being used anywhere. Now rupees 50 crore are available, and those can also be used so as to meet the net working capital over there. So as to meet up with the net working capital over there. Is that clear? So that's the case that the net working capital is either equal to the current assets which are exceeding over the current liabilities over there, and also it is the long-term sources exceeding above the long-term uses over there. Okay, so that's the case with the gross working capital and the net working capital over there. I hope that you must have understood the concept related to that. What is gross working capital, what are current assets, what are current liabilities over there, what are long-term uses, what are long-term sources over there. Okay, so that's related to it. And now let's move further. It's related to working capital. Now what is working capital? I told you in a nutshell that it is the amount which is actually required by the business for day-to-day expenses. That is working capital. Now what is the type of the working capital? We have already learned about the gross working capital. Now gross working capital is the total amount of the current assets which is available with the company over there. Okay, so when we will be going through the balance sheet, just look at the total current assets, and that is the gross working capital over there. And if we look at the net working capital, it is the amount of the current assets which is exceeding over and above the current liabilities over there. That is a net working capital. That is a net working capital over there. Now, what is working capital management? What is working capital management? Now, working capital management involves management of both the current assets and also the sources to finance them. Okay, so whatsoever the current assets you are having right now with you, and whatsoever the different sources are available with which your current assets will be increasing, with which you can actually finance those current assets over there. So that's actually the working capital management over there. Okay, now let's have a look at the broader funda that's related to the working capital cycle. Let me just erase it from here. Okay, the next thing that we are going to learn, it's the working capital cycle. Now, what is working capital cycle? What is working capital cycle? Now, first of all, understand the case that we are having the cash in hand. And we purchased the raw material. We were having the cash in hand or the bank balances, and we purchased the raw material. And further, now this purchased raw material we converted into the finished goods over here. After finished goods, we will be selling these goods over here. And further, when we will be selling these goods, it may be the case that we may be receiving the cash directly, receiving the cash, or it may be the case that we have sold the goods on credit. It's always there now that we have sold the goods on credit. In that particular case, the process is elongated because you're not be receiving the cash directly over there. Okay, I'm making a sale. Person A is selling the goods over here. Person A sold the goods for the cash. In that particular case, person A will be receiving cash instantly. Okay, but in the other scenario, person A sold the goods to person B over here. Person B has not paid the cash yet, and he'll be paying the cash after 1 month. Now, in that particular case, the process is elongated, but because person A over here will be receiving the money after 1 long month over here. So that's the case that you need to understand. So that's the difference between the credit sale and the cash sale over here. Okay, so now that will be elongating the process, and the company will be having lesser funds in hand, because I told you that the current asset is actually related toward cash in hand or bank balances, stocks over there, account receivable over there. But if we look at the account receivables, that's not the actual amount that you're having right now in your hand. That's the amount that you will be receiving in a very short span over here, but it's not the actual amount that you're having right now in your hand, and that cannot be used for the daily day-to-day purposes over there. So that's the case related to it. Is that clear? Okay, so that's the operating cycle. The cycle which we have read over here, that's the operating cycle. Okay, so operating cycle is related to what time it will be taking. So as to convert the cash again into cash. Because the process is related to what, that will be purchasing the raw material. We will be actually processing that raw material and will be converting them into the finished goods over there, and further we'll be selling those goods over there. We'll be collecting the monies over there. So that's the case related to it. Okay, now that's called what? That's called the working capital cycle over there, and the length of this cycle depends upon some of the factors. What are those factors? First of all, what stock of raw materials that we are required to hold each and every time. Let's take the case, if we are like that, we have to hold at least 1 crore rupees of the stock at each and every time over there. Average stock is to be maintained at rupees 1 crore. In that particular case, we have to maintain our inventory at rupees 1 crore. Whether that is being in use or not, we have to maintain a inventory of rupees 1 crore over there. Definitely our operating cycle, our working capital cycle will be elongated now. And further it's related to what time it will take in WIP. What time it will be taking in WIP, or in case of what inventory will be creating, or what amount of inventory will be keeping up with us in WIP. That is a work in process. Okay, so as to basically work in process means the time period it is taking to convert the raw materials into the finished goods. Okay, the time period in between, that is a work in process. Now, if work in process time is elongated, definitely our working capital cycle will be elongated. Let's take the case that previously we purchased the raw material. It took 3 days for us to purchase the raw materials, and further we converted it into the finished goods, and it took a time period of 15 days in between, and further we sold the goods. Okay, that's the separate part. Now, if this particular period, that is a work in process, is elongated, let's take now it is taking 18 days. Definitely previously our working operating cycle was somewhat lesser, but now it is elongated. Okay, so that's the case related to it. And it may also be the case that if the credit required by the buyer is now increased. Previously they were asking for a credit period of 1 month, but now they have been asking for a credit period of 45 days. In that case also your working capital cycle will be elongated. Okay, and longer the working capital cycle, that is beneficial or not? Is that beneficial or not? Can you please do let me know right now? So now if the working capital cycle is elongated, we learned about the working capital cycle, that what is working capital cycle, and I have told you each and everything in detail. Okay. But now the question is, if the working capital cycle is elongated, would that be beneficial for the firm or not? No, definitely not. That will not be beneficial. Why will not that be beneficial? Because it will take much more time so as to convert the cash into cash. Okay, it will be taking much more time, and definitely we want the cash at the earliest so that we can utilize that cash for our day-to-day purposes over there. So that's not actually required. That we don't want to do that. Okay, every firm wants that, they want to receive the instant cash. Okay, and further, the current assets or working capital of a firm, the current assets or the working capital of the firm. I told you that we are having the different type of the current assets, like we are having the cash in hand, we are having the bank balances, we are having the account receivables, we are having the book debts, we are having the what's of the different amounts of the stock or inventory or the finished goods amount over there. So those all are actually related to what, those all are the current assets, and that is actually what, that is a gross working capital, that is a GWC. So GWC is related to what, it is a total current assets which are available over there. And if we look at the net working capital, it is the total current assets, or simply current assets minus the current liabilities, that is a net working capital over there. So we need to understand these points. These are some basic points related to the working capital management over there. Now nature of business. Now public utility undertaking. Like where they have been renting the services, like electricity department, water supply, railways, they do require very little working capital finance structure over there. Why they do require very little finance structure, working capital finance? Because they have been rendering services. They have been rendering services on cash terms. Like each and every month you are to render the services and you will be receiving the cash. You are not finance hungry now. You are not finance hungry. But if you are talking about a manufacturing firm over here or an industry over here, which it is taking 4 months so as to produce the goods, 4 months so as to produce the goods, and after 4 months they will be selling the goods, then they will be receiving the cash. Definitely they do require a much larger working capital limit over there. Is that clear? Okay, so it actually depends upon the working capital of the firm. Depends upon what? It depends upon the nature of the business, that what type of business we have undertaken, and also it's related to size of business. Over there. So greater the size of business, greater is the requirement for the working capital. That's directly proportional to it. And for the production policy. Now, if the production policy is to keep production steady, not geared to peak and non-peak nature of the business line, then the accumulation of the inventories will be there in the off season, and further you'll be requiring much larger working capital. Like if we are having the production policy that we want to actually have a stock of the finished goods. Okay, like we are operating in the months of from September to January each and every year, and further our off season is from February to August. Okay, but we are having a production policy that will be maintaining at least stocks worth rupees, finished goods worth rupees 10 crore. Now 10 crore rupees are required over there so as to be maintained. Okay, so that's, you will be requiring a much larger working capital limit. Okay, then it's related to seasonal variations. Now seasonal variations related to what, like if there is some hosiery, definitely they will be requiring much more funds in the months of operating period of operating months over there. Okay, then it's related to operating working capital cycle. That is the duration of the operating cycle that determines the requirement of the working capital. Now if it is elongated, much more working capital is required. Now if the working capital cycle is elongated, much more working capital amount is required by you. That's the case with it. And then it's related to sources of finance for current assets. Sources of finance, from where the firms can finance the current assets. First of all, it's related to firms on working capital funds over there. Okay, like I told you that we are having the long-term sources. Long-term sources are what? Like capital and reserves, and further the long-term liabilities over there. These are the long-term sources which are available with the organization. Now the capital, actually the organization can use these long-term sources of funds as the working capital. These can be utilized as the working capital over here. That's the first case. Okay, so that's the first case over here. Now if all the all the current assets are actually financed by the short-term sources over there, now definitely in that particular case the company may face an issue related to the cash crunch, where the cash will not be available with the company over there. So company must be having something in hand that's actually quite required so as to be robust. So the working capital must be managed, a portion of the working capital must be managed through the long-term sources over there. I told you the assets are the uses and the liabilities are the sources of the funds over there. Is that clear? Then it's related to accruals. Now what do you mean by accrual? Now what do you mean by accrual? Now let me just give you a simple example. Let's take the case that one person started working with you from 3rd of the February. And let's take the case you will be paying the salary on the 10th of the next month. On the 10th of the next month, you will be going to pay the salary over there. Now the person will not be receiving the salary. The person has started working for you. Now the amount of the salary, let's take the case that you are paying amount of rupees 50,000 per month. You are paying the amount of 50,000 per month as salary. Now 50,000 amount is accrued, that you are having a liability to pay rupees 50,000. That is payable. Okay, but you have not paid so far. So the payables, the salaries payable account is now standing at rupees 50,000, but you have not paid the amount so far, because you are going to pay the amount on the 10th of the next month, that is 10th of March over there. So that is actually what, that is the amount that is accrued. That is the amount which is accrued over there, but you have not paid so far. Okay, so that particular amount which that you have not paid so far, that can be utilized somewhere else till the time you have not basically paid it, or you are not to pay it. Okay, so that's the case of the accruals. So that's an extra source, we can say, of the working capital which is available, which you can utilize for your day-to-day management over there. Okay, so that's the case related. Then it's the case of the trade credit, like you are allowing your customers to basically purchase from you on a credit. You can get a trade credit too. Let's take the case that I am buying the raw materials, and further I bought it from the supplier, and he allowed me a credit of 3 months. Now I have already bought the raw material, but I am to pay for raw material after 3 months, not right now. I am not to pay the amount right now. Okay, so that's the case. Now this amount of credit which will be allowed actually depends upon some factors, like the industry practice, if it is being there or not. It could be related to the payment record of the firm. Now let's take the case the same vendor is not allowing a credit to credit to XYZ, but not allowing a credit to ABC because the credit worthiness is not there. Okay, so that could be there. And further, it's related to firm's profitability. Now if the firm is profitability for the last few years, it may be the case they may be allowing the credit to the profitable firm, but not to the non-profitable firm over there. Okay, and the amount of the credit is to be availed depends upon what? Amount of credit that is to be availed, it depends upon what? It depends upon cost of credit. Now if the vendor is actually allowing a credit, but allowing a credit on a percentage of 18% per month, and XYZ finds that it's quite high, the rate is quite high, then in that particular case XYZ will be opting for the lesser credit. Okay, but if the credit is being provided at 9% and XYZ finds it fit, okay, they can avail the credit for a much more amount over there. So that's the case related to it. Okay, and also if XYZ is immediately paying the amount, definitely they will be asking for discounts. Let's take the case that the ABC, let's take the case PQR is a vendor over here, and further they have supplied the goods to them. In that particular case, XYZ may ask that we will be paying the amount directly, what discount you will be offering. Okay, so that's actually related to it. Supplier can offer a discount for the instant payment over there. And the liquidity position of the firm also actually conveys an idea that what amount to be actually availed as a credit or not. Now a firm will be negotiating for a higher credit period if its liquidity position is not comfortable. Now if I'm not having the funds in my hand right now, definitely I'll be asking for a much more longer credit period over there. Otherwise, if I'll be having the cash in my hand, definitely why would be I asking for the credit period? I'll be saying just take your money and give me my raw material, that's it. Okay, so on the other hand, if the idle cash or a satisfactory level cash is available with the firm over there, they will prefer to negotiate a reduced credit period in exchange for a discount over there. Is that clear? Okay, then it's related to the working capital advance. After that, it's related to the working capital advance. Now working capital advance provided by the commercial banks, it is being provided. Now we are actually talking about the sources now which are available. Now we have learned about the trade credit. We have learned about the next it's related to what? It's related to the working capital finance. Now XYZ firm is over there. They can get CC limit sanction, that is a cash credit limit sanction over there, which is actually sanctioned for working capital purposes only. Okay, so that's actually related to this, can be sanctioned by the commercial banks, and it can be in the form of the fund based or non-fund based facilities. Now fund based facilities are there where there is direct outlay of the funds. Like in case of CC limits, there is direct outlay of funds. Now funds are being actually disbursed directly to the XYZ firm over there. But if but let's say if some other facility is given, let's say bill discounting facility is given, let's say bill discounting facility is given, or letter of credit is being opened, in that particular case there is no direct outlay of funds. Now in case of CC, there is direct outlay of funds. Let me write it over here. In this particular case, there is direct outlay of funds, but in case of bill discounting letter of credit, there is no direct outlay of funds. There is no direct outlay of funds. Now if there is no direct outlay of funds, those are said to be what? Those are said to be the non-fund based facilities. Now in this particular case, the facility, the liability is direct, but in case of this, the contingent liability is there, because the liability may arise in the near future. So it is a contingent liability in this particular scenario over here. Is that clear? So that's the case of the working capital finance over there. And also the firm can actually raise the funds by using the public deposit over there. So that can also be there. By finance requirements for current assets, the amount can be actually be raised through the public deposits, and the interest rates of such deposits are not regulated by the Reserve Bank of India. Interest rate will depend upon the financial stability of the firm, reputation and prevailing market conditions over there. And the Companies Act provide the detailed requirement related to that what requirements must be fulfilled by the companies over there so as to raise the public deposits, over there. Then it's related to inter-corporate deposits. Inter-corporate deposits means what? Let's take the case, we are having a corporate ABC and the other corporate is XYZ over here. Now for a shorter period, let's say 3 months or 6 months, they are actually giving funds to each other. Let's say XYZ availed funds for 3 months from ABC over there. So that's what? That's an inter-corporate deposit. So that's a inter-corporate deposit over there. Is that clear? Now, in case of call deposit, the deposits can be withdrawn by lender. The deposits can be withdrawn by lender by giving 1 day notice. Okay. Now, if ABC can withdraw the funds whichever lent by ABC is a lender over here. Okay. And further, XYZ is a debtor over here, to whom the debt has been given, or ABC is creditor over here. Okay. Now if ABC gave 1 day notice to XYZ so as to withdraw the funds, so that would be what? That would be the call deposit. That is said to be the call deposit over there. And the duration of these inter-corporate deposits can be for 3 months or 6 months. So these are for shorter periods. This is not for the long period. Okay. So that's an inter-corporate deposit which can be there. And also it's related to rights debentures for working capital. Now what do you mean by right issue? What do you mean by right issue? Right issue is related to, let's take the case that you have already issued the securities. Let's take the case, these are the investors A, B, C, D. These are the investors over there. Now, again, I'm giving an opportunity. To these existing investors. These are whom? These are the existing investors over there. And again, I'm giving them an opportunity so as to buy some security again. So that's a right which is available. It's not an obligation. It's not an obligation for A, B, C, D, that those are the existing investors, that they are to buy those securities again. That's not mandatorily mandatory for them. It's just a right which is available, not an obligation. Okay, so they can do invest into those securities again. In this particular case, right debenture, the debentures will be issued to those existing debenture holder, and further that will be for the working capital needs itself. Okay, so that's actually related to the from where you can get the funds. Now, when you are issuing the debenture, it's not for a shorter period, it's always for the longer period. Now, whether your objective is to augment the long-term resources of the company, but you can use those resources. Now, we got the amount for long-term purposes. Now, let's take the case that existing shareholders or existing security holders again invested into the debentures over there. That's through the right debentures over there. They have paid amounts, and the company has basically raised a fund of, let's say, 10 crore rupees. Now 10 crore funds are available. Those are available over there for longer period, because debentures whensoever are issued, those are issued for longer period, not for a shorter period. Okay. No, but these this amount can be utilized for working capital purposes. This can be utilized for working capital purposes because I have already told you that long-term sources can be utilized for working capital purposes over there, but there are some conditions related to it which amounts cannot be utilized for working capital purposes or which can be. So we will be that's some other part related to it, but right now we are basically concentrating on the same. Then it's related to commercial paper. Now, what do you mean by commercial paper? Commercial papers are actually the unsecured money market instrument. Now, what do you mean by money market instruments? Now, money market instruments are those instruments which are issued for a period of 1 day to 1 year only, not more than that. And these commercial papers are unsecured money market instruments, and these are issued in the form of the promissory notes over there. Now, what do you mean by promissory note? Promissory note is like where the one person is promising. There will be an unconditional promise. There will be what? There will be an unconditional promise from one party to another that they will be making payment to the same. Now, in this particular case, the organization, let's take case XYZ over here, is going to issue commercial paper, and each and every commercial paper, let's say, is worth rupees 5 lakh over here, and they are promising that they will be paying this particular amount after 6 months. Let's take the case they issued the commercial paper for 6 months period over there, and investor A invested into this, and investor will be paying a discounted value. A discounted value means these commercial papers are actually issued on a discount on the face value. The face value of the commercial paper, let's assume it is rupees 5 lakh rupees, and these are issued at a discounted price of 4.5 lakh rupees. In this particular case, person A, who is an investor, will be paying rupees 4.5 lakh rupees to the XYZ company over there, and further after 6 months, company will be paying rupees 5 lakh to person A over here. So that's the scenario with it. Okay, so that's the case related to it, and it was introduced in 1919 in India with a view to enable highly rated corporate borrowers to diversify their sources, because the government also wanted that the corporates must be diversifying their sources of working capital management over there. So commercial paper was introduced. Now the firms can get finance from different sources. Like firm can get the finance as a CC limit from the bank itself. They can get the trade credit over there. They can get the inter-corporate deposits can be there. Public deposits they can raise from. Okay, and also it can be in the case of the commercial papers, they can get the amount from. Okay, so these are the different sources we can say which are available, and also by way of factoring and forfeiting they can get the amounts. Okay, so these are the different sources which are available over there. Okay, and so commercial papers shall be issued minimum denomination of rupees 5 lakh and multiple thereof, and these are issued at a discount to the face value over there, and minimum maturity for commercial paper is 7 days and maximum it is 12 months over there. Now there is a point that you need to understand, because I told you that commercial papers are being issued by highly rated corporates over there. Now by whom these are rated? Now let's look at XYZ is a corporate, so these are to get the credit rating from the credit rating agencies which are actually registered with SEBI, that is Securities and Exchange Board of India, and there must be 2 credit rating agencies which will be actually rating the XYZ over here. Let's take the case that XYZ was rated by 2 credit agencies, CRA1 and CRA2 over here. Okay, CRA1 rated it to be the A3 and CRA2 rated it to be A2 over there. Now the minimum rating of these 2 will be taken, like we in this particular case will be taking A3, which is the lower one over here. Okay, so the lower rating is to be taken, and also these CRAs, that is the credit rating agencies, will be issuing this credit rating for a specified limit over there. Let's take the case that the CRAs, that is the credit rating agencies, issued the credit rating for a period of 6 months. Okay, these issue the credit rating for 6 months. Now as per the fact, the commercial papers which will be issued by the XYZ will be expiring not more than 6 months over there. Those are to basically comply with this rating methods over there. Okay, so that's the case related to it. Okay, now who are the eligible issuers of the commercial papers? Now companies including the non-banking financial companies, all India financial institutions are eligible to issue the CPs subject to the conditions that the tangible net worth as per the last audited balance sheet is not less than 4 crores over there. And also the other entities such as the society, unions, government entities, limited liability partnership, and any other corporate can also issue the commercial papers if they are not having net worth less than 100 crore rupees. Okay, so they must be having a net worth more than 100 crore rupees so that they can issue the commercial papers. And also they must be having a standard working capital limit must be there. All their loans must be of standard category, so that these are the conditions which are there. If we look at the rating requirement, I already told you that the eligible issuers are to obtain the credit rating from the CRAs which are registered with the SEBI over there, and further 2 ratings must be there, and the lower of the 2 ratings are to be adopted over there. That's the case related to it. And the minimum credit rating which is prescribed by SEBI, that is the A3 symbol, that is the A3 rating. Okay, and if we look at the secondary market, so secondary market is available. Secondary market is related to first of all, primary market is related to what? Like if we are purchasing directly from the company itself, if we are purchasing the commercial paper directly from the company itself, from the corporate itself, that's a primary market where the commercial papers are issued directly to the investors over there. That's a primary market. Now after the purchase, when these investors are purchasing it again between themselves, okay, or selling between themselves, that's the secondary market. That's the secondary market. Now for the purposes of the commercial papers, this secondary market can be operated through the stock exchange, and this can be operated through the OTC, that is over the counter deals also. Over the counter deals means one person will be exchanging it with the other person. Okay, now in case the deal is OTC, in case the OTC deal is there, OTC trade is there, that must be reported to the required platform within 15 minutes. Okay, required platform within 15 minutes. And further, no loan is actually permitted against the commercial paper, that is not allowed actually. And if the maturity of the commercial paper is on holiday, in that case commercial paper will be matured on the previous day. And for the buyback of commercial paper is allowed only after 30 days. It is allowed after 30 days over there. Is that clear? Is that particular point clear over here? Then it's related to factoring. The next point, it's related to the factoring over here. Now what is factoring? Now let me just give an example. Let's take the case that person A has sold the goods to person B, person C, and person D over here, and these goods have been sold on credit of 3 months. The credit for 3 months is allowed. Now in this particular case, the firm A will be receiving the funds after 3 months only. Okay, they will be receiving the funds after 3 months only. Okay, so it may be the case that they must have drawn the bills, or it may be the case that these are the regular parties of A over here and they do trust on each other, and further credit has been allowed. A credit has been allowed. In that particular case, the amount which is to be received, that is said to be what? That is said to be the accounts receivables. The amount is actually shown in the balance sheet under the account receivables. Okay, so these are the account receivables over here, right? Now the firm A is requiring the funds over here. So firm A, that is related to what? That will be actually visiting a company which is said to be what? Which is said to be factor. Now all the actionable claims, because they are having a right, all these actionable claims or book debts will be assigned by firm A to this factor over here. Okay, and after deducting a margin, let's say the amount will be paid by the factor to the firm A over here. Okay, let's take the case that the total book accounts receivables were amounting rupees 10 lakh. These were amounting rupees 10 lakh, and let's take the case after having a margin, the factor actually liquidated the A with the required amount. Let's take the case that they maintained a margin of 15% and an amount of 8.5 lakh. Amount of 8.5 lakh as a liquidity was given to person A. Now on the maturity, the factor will be receiving the amounts from these persons to whom credit was actually allowed. So factor will be receiving the amount. So that's the case with what? That's the case with the factoring over here. So we are having the three parties. We are having the debtors, we are having the client. So person A is what? Person A is the client over here. These are the debtors over here. And for the factor is what? It is a financier. Okay, so that's the case with the factoring over. Now this factoring can be with recourse or without recourse. Now what do you mean by with recourse? With recourse means if the amount on due dates were not paid in time. Let's take the case that B has not paid the amount in time. Okay, in that particular case, factor can get back to the client over here, that is a person A over here, that he is to compensate the loss. He is to compensate the loss. That's the case in case of the with recourse, where the factor can get back to the client over here. And if it is the factoring is without recourse, if the factoring is without recourse, in that particular scenario, the factor cannot get back to person A, that is a client, even if the amount is not being paid by the debtors over there. Okay, so that's the case of the factor over there. The next is related to factoring. The next, it's related to the forfeiting, not factoring, it's related to the forfeiting. Now, forfeiting is actually the same concept, but it's actually in the case of the international territories. It's a case of the international territories. Now, let me just give an example. Let's take the case that the person A is over here in India, and further they are having the buyers from some other state, let's from some other country, let's say USA. Okay, now the amount is receivables and the amount is to be received, and it's in its books receivables or account receivables over there. Okay, now person A went to some company, let's say it's a forfeiter. Previously it was factor, now it is forfeiter. Okay, it's a forfeiter. Now forfeiter will be providing 100% of the liquidity after deducting their margin, after deducting their own margin. They will be providing 100% liquidity to person A over here, and will be purchasing these accounts receivables. Now forfeiter will be having a counterpart in USA. They will be having some counterpart in USA through which they will be actually collecting the amounts from the buyers from USA. Okay, so that's the case, because the forfeiture is related to, or forfeiting is related to the international territories. Okay, so in this particular case, the factoring was for short term period, but the forfeiting is for the medium to long term period. And moreover, in case of factoring, the finance was from 80 to 90%, whereas in case of forfeiting, it is 100%. And further, there is an option that in case of factoring, it can be with recourse, it can be with or without recourse. But in case of the forfeiting, it is always without recourse. Over there. Okay, so these are the differences between the factoring and forfeiting. So that would be all related to today's video, and the next part of this chapter we will be covering tomorrow along with some other unit. So that will be all related to it. I hope that you must have liked the video. If you have liked the video, kindly please rate this video out of 10. Kindly do rate this video out of 10. And also the full courses are available, which you can enroll visiting the website iibf.info. Let me tell you what will be the content. You'll be getting the full course videos, chapter wise videos will be there, and these are available in English as well as in Hindi mixed English language. So you can avail as per your choice. Hindi mixed English language videos are also available, and it will also be covering the chapter wise questions over there. So chapter wise questions will be there, mock test will be there, mega tests will be there, mega mock test will be there, and also you'll be getting the complimentary access to the ePDF notes. Okay, so these all contents will be covered over there. So do enroll right now, and further you can avail it at flat 82% off. Use the coupon code new 2023, which is going to be expired very soon now. Okay, so do apply the coupon code, and further you'll be getting the double validity dhamaka, wherein the cost of 6 months of the course you'll be getting the 12 months validity. Okay, so do enroll right now and start preparing for the same. So thank you so much, and see you again in the next video tomorrow. So there will be daily live class series in the morning from Monday to Saturday from 6:30 onwards. Okay, so that will be all. So thank you so much, and see you again in the next video.